All right, good evening, guys. Thank you for your patience. It is the nightly Tortoise Strategy podcast for September 10th, 2020. Eugene, I'm thinking about this. We were doing this back in March of this year when things first started unraveling, and it's been every night for 6 months, and it just sort of feels like it's starting all over again, kind of a Groundhog Day. And so maintaining the emotional resilience and the energy level and the vitality and the adaptability and the willingness to keep going back to the salt mine to keep it going. That's kind of what it takes. It's going to get dumber before it gets smarter this year. Holy mackerel, you know? All right, so let's take a look at what we got here. So just 5 days ago, we were pushing the all-time high. You know, it was a 10-day high and a 30-day high. And the RL10 peaked, crossed the baby dragon, crossed the 30, encountered the dragon, blew right through it. Now I'm tracking the RL10 as it crosses the RL90, the spine of the dragon, the Z1, through the PSAR. That's when you officially get that RLXD. And so that tactical time, you know, where you're hoping to see it do this and make a recovery, is sort of over. And now we got this mess. Well, there were two more big sell-off days. The RL10 came out of the river, or came out of the dragon, I should say. Crossed the Bollinger Band mean today and is now halfway between Z0 and Z minus 1 on the RL10. So that's our RL10 price. And in this short period of time, it's gone from Z plus 2.5. I guess the RL10's rated Z2 plus 0 to almost Z minus 1. So 3 sigma in a matter of 5 days. And it took, you know, here it was at Z1, got to Z2, came back to Z1.5, back to Z2. And that's, you know, that's like 25 days when it was in that nice tight band being tracked by the dragon all the way up. And now in a matter of 5 days, the truth changes. Oh, I didn't want to do that. I just wanted to erase anything about the whole doggone thing. Sorry about that. Let's try that again. Yeah. Okay. So we had this big sell-off from the 10-day high, and we made a new 10-day low here. And then yesterday was full of promise. It had a nice little gap up, blew through the Bollinger Band mean, but as we said yesterday, a bit troublesome. It couldn't make a new daily high, and it was encountering, you know, the skin of the dragon. I should probably put that in red, huh? Or a bright orange. So it's encountering that skin of the dragon. Notice how important that dragon is right here. I want you to notice when things are nice and tight and moving along in a relatively narrow range, that dragon is very narrow because the price has almost no volatility. That makes the dragon very tight. When you start getting this exaggerated volatility, now notice how wide that dragon gets as he makes that big wide turn. And now this turning point, if it's going to continue to do that, you can see the RL30 projection here, and you can see the PSAR projection here. That's sort of the deep defense. But this dragon projection here, if this stays true to form, much like it did on the way up, that sort of sets the real strong boundary for price. If that dragon remains strong resistance and continues to decay, then we're going to be seeing price coming down here back to the peak RL 270, down to the 30-day low. And that's a cause for concern. I'll have to research bamboo to see if there's some way that I can just erase ink. There probably is. All right, so we're going to look at our four U.S. indexes. So the S&P was the worst at minus 1.77. Diamonds at minus 1.46. Small caps minus 1.3. And then treasuries at plus 0.5. I would just note also that the Bill Ackman hedge fund at PSHCF was up a quarter. So looks like he's gone to pretty defensive plays as well. That's good. Good for him. So this is clearly a case where the broad market selling. There were some tactical plays now by the short-term tactical traders here in the Russell, and the large caps preserved a little bit of gains. The sectors that outperformed the S&P, so it's down minus 1.7. Got healthcare and emerging markets at minus 1.5. Discretionary XLY and finance at minus 1.45. Silver minus 1.2. Materials, basic materials, XLB at minus 0.97. Mexico minus 0.9. Then in the green, Japan basically breaking even at 0.03. Treasuries 0.5. Tesla, one of the few bright spots today, up plus 1.38. So the companies that did better, Google, Twitter, Cisco, and Intel among the techs. You got Home Depot, Nucor. Among the materials, you have Goldman. Oh, and there's also U.S. Steel. Then Goldman Sachs, better than finance. So Goldman Sachs remains the strong financial symbol, but not much good news in there. The things that were worse today. So you get the S&P again at minus 1.77. You have this cluster of sectors: oil, technology, clean energy, and Wheaton, minus 2.2 to 2.7. You have Brazil minus 3.2, energy minus 3.7, commercial real estate minus 3.9, Oil exploration minus 5.6. The triple techs down minus 5.7 and minus 6.6. So they got slaughtered. Nikola Motors gave back another 11%. So talk about a roller coaster. 2 days ago up 40%. Yesterday down 20. Today down 11. That'll keep you awake at night. Some clusters of companies that were underperforming the S&P. There's Boeing, Caterpillar, and then some techs: Facebook, Microsoft, Amazon, Nvidia, and Apple. So big sell-off there in Apple and Microsoft. So even the techs that were making money earlier this week are giving it back. So that's really distressing, very distressing. Let's see if this rascal wants to cooperate. Let's try a speed run here real quick. So all I'm going to do now is take a look at the dailies. We have been taking the general position that in these times in a critical state, we've been framing trades with really tight boundaries and playing the breakout from the yellow zone. And so we've had Alcoa has broken out to the downside. Let me get this. So Alcoa broke out from here, 2 big days down, right on the edge of collapse beyond Z1. So anything short of 1376 is an auto short, and it's going to come all the way back to if it does that, back to this cluster. So we're talking at like $13. So there's about a full dollar. That's about a 6 to 7% sell off in Alcoa waiting to happen. Apple suffering has fallen below the dragon, below the Bollinger Band mean, testing the 10-day low and ready to collapse further back to fair value. Amazon showing so this is what tactical trading looks like. So way back here we framed this trade for a breakout and we were ready to go in either direction. That's what that orange dot means. So there was a gap up, so you got one nice directional move up. Today it gapped up, sold off, and then you have a move from 33.50 down to 31.50. So that's like a 8% intraday sell-off all the way down here. So large directional move. And if this doesn't hold, it's going to come at least down to 3,100, and then long-term fair values down here around 3,000. Because if this collapses, it comes back to here. Boeing, just the bottom has fallen out of it. Again, we framed a tight trade here. It broke down and just spent 3 days just selling off. So that's a breakdown from 168 to 157. That's about $10 on 160. It's 116. That's about a minus 7% from this trade frame. And you'll notice that the sell-off was as large as the move up. So here's a place where if it was going to hold support, you'd think it'd be here. And it's moved from 155 to 190 before, but this feels different, doesn't it? But I would also be ready, just because of the fact that the market is testing its 7 or 8% sell-off. A nice trade frame right there could give you a nice move off that low. So that's I think an opportunity in Boeing. Caterpillar, And this is one that has just been the anomaly. From here, we got a nice big breakout sell off. There was opportunities in here to keep those gains, but it is still holding above the breakout. That's one of the few symbols you can say anything about. So if we do have any kind of recovery tomorrow, you would again expect Caterpillar to be one of the stronger companies because it has had relative strength where the rest of the market in the Dow in the U.S. has been weak, and it's been following this breakout path from our previous projection nicely. So I'm not afraid of owning that one if it breaks out above, let's say, 150.5. Cliff just getting shredded. Again, the breakdowns from the critical state short closing weekly. Now it's below the Bollinger Band mean. Now it's going to come back and test this at $5.34. And this is a symbol that has in previous times, on the previous run-ups, got as high as $7, but now it's already back down to 6. That's a 14% sell-off from that double top. Salesforce, I think, is rejecting this support level and looking to go lower. There's still more room for that to suffer. Cisco has been among the weakest of the techs, and this just got a new breakdown. So we had that one, then the second one, now the third one. So if it breaks down here, this thing's just going to keep going, and it's already going to test that bend in the river right there. 38 is in play to the downside, and if that fails, it's down here to 36. So both of those are in play to the downside. And then on the recovery, it has to get to it has to get through the dragon to be serious. So that means the potential upside here, the easier trade, is 39.5 to about 42. So there's about 8 to 10% available on the way up. So that looks like a high priority trade to me. So if tech makes a recovery, Cisco will be seen as on sale. That's one that I think would be very interesting for us. The Dow testing a double bottom here. The breakdown rewarded the downside today. So now this target here at 270 is the previous support level. And then to the upside, it's got to get through, the upper skin of the dragon. So that makes this whole region in here the tactical trading space. And there's a strong trade in either direction waiting. So this is a market that's ready to explode in either direction. Devon Energy, just as bad as it can be, has basically rejected all of the gains that it made all the way through here. So all that stuff is gone. And now the next leg down takes it to here. So that's just as bad as it can be. Emerging markets suffering like the rest of it. And again, you can see how strong that support level is going to be at Z2. And if that breaks down, then it comes all the way back to here, all the way to Z3. So that's a sell-off of about 5%. Japan basically broke even today. So maybe as a defensive play, but I just don't see much growth in it. There's not much difference between that just holding cash. Mexico rejected. This was such a great frog trade today. It gapped up to here and then just sold off the entire day from 32.5 all the way down, or 33.8 down to 32.8. So 4% intraday move, as it couldn't stay above the Bollinger Band mean. And you'll notice that the Bollinger Band mean is rolling over. So that run is done, and now the slope is down, and we're in the winter. And if it follows this path and breaks down below 3250, then there's a big leg down. So that's the first stage. I'd be looking to play that breakout there. Either direction. Brazil. Another big frog directional move today. And it's going to come down and test. Once it breaks through that PSAR, then it's going to come down and test the bottom of the PSAR here at 2950. And then if that breaks, then it's into the red zone. And then it comes down all the way to here. So 2 stages down. So all of its outperformance from the past week is over. Facebook just collapsing out of this critical state that we looked at. It's had 4 days of downward pressure. And broke to a new low. And so the next level is down here at the skin of the dragon, about 260. So that's about a $10 move to here. And then it's down to Z1. And then if this breaks, it's back down here to the belly of the dragon at 230. So there is no joy in Mudville for these guys. So that's what the collapse could look like very easily, back down to here. Okay. Conversely, to the upside, if this finds support here, then it gets back up to 285. So there's potential for this breakout. Okay, so I'll play the breakout of the yellow in either direction. I like that. Chance to buy Facebook on sale. Google. Come on. And we're locking up. Great. All right. So that gives you an idea. That's the first dozen. The rest of them are going to look similar to that. Let's go to the daily. Let me get this done. I'm getting ready to cut some birthday cake for my son, turning 29 tonight. He's at home diligently working on his dissertation. He's writing it in the language of math, which only indirectly resembles the English language. Okay. So still bullish normal. Remember, now we're back down to just 8% above the 200-day moving average. That's what used to be 15%. Overbought long term, but otherwise starting to show some weakness, and then real serious weakness on the 3 and 10-day NDX. Risk C, reliably reminding us abnormal downside risk. That bullish trend is still strong at 35, but that's 10 points lower than it was at the peak of ADX. So remember, on the way up, we were using that as an indication that the strength of trend was so abnormal that it couldn't maintain that forever. When it got above 40, it was above 2 sigma, and that was a concern. So that's a piece of early warning. It's stuck in the oversold conditions. Risk Z still warning us about the potential. Is it going to be one of these that turns right at about this level? Or is it going to be one of these, that comes down and gives a second leg down? That would be another, if it comes down to there, that would be another 7 or 8% sell-off to come down that far. Lots of overreactions and channeling, just showing you how boldly oversold everything is. Min pains are the ones that are closest to their 10-day high. Not much to love there, though. And then Apple, Microsoft, and Salesforce in the tech land. Devon Energy and Apple, Conoco, and Halliburton. So the whole energy sector and tech just getting slaughtered. Lots of channeling and overreactions here in the Dow. Plenty of auto framers that test out very well. But again, I think we're looking at it's a market condition right now that matters the most. Cisco was especially smashed today. Walgreens just couldn't be any worse. Even Microsoft is now underperforming on a 10-day basis compared to the rest of the Dow. Coke and a hamburger were at Disney. I guess that was the place to be wearing your Nikes. That's the opposite of tech. It's consumerism while the sun is shining. In the ETFs, plenty of channeling and overreactions and measured moves back to the 10-day high. Oil exploration just getting murdered, and the energy sector itself. And Brazil has given up its little gains right there. Those are the relatively defensive plays, I should say here. Japan, gold, treasuries. Nothing above the river. Caterpillar is best, though. Cisco and Microsoft, disappointing traditional techs. Lots of auto framers because of the significant distance away from the 10-day highs. And so you're getting some, there's not surprisingly oil and oil exploration, Salesforce. Welcome to the Dow. Energy. The S&P, Walmart, Apple, Tech, and Cisco. How do you like them apples? Microsoft. Nothing tests out better than 2-to-1 on the one-day pops, although the things that are in the best shape, the defensive plays of gold, silver. Cisco has a possibility of a breakout here. And Walmart, those would be the 4 that I look at. Tons of things in the fall. Let me let that come up on your screen. Yeah, tons of things in the fall and the winter. Only real estate showing any kind of support. Coke, McDonald's, Disney, Walmart, Caterpillar in the summer. But then a ton of things in tech land that are getting slaughtered in the winter. Techs and energy, that is. And then just a lot of things in the fall. The big losers today highlight the bright reds, but especially Walgreens. I wonder if there's still a chance to get short that guy. Energy and oil exploration. Even Asia less Japan suffering. Materials, gold, and treasuries, the world of things. There are times like right now I'm in full coyote mode. Master opportunities, short-term tactical plays first. Don't get caught. Stay light on your feet. One of the few animals in North America who is expanding his range under these treacherous times. The master adapter, the trickster. Real weakness in here. The slope of the RL30 rolling over. So if this dotted line, that long-term average, were to break, then this thing could get ugly in a hurry. And then if that happens, the stretch, which has pulled back this far, that's about a 7 or 8% stretch, could give you another 7 or 8% stretch before it gets down to abnormal, and that would be this support level at about 330 in the S&P. Well, we're almost there now, so more like 320. That's what that sell-off would look like. Volatility starting to spike up. The RL10 really starting to get abnormal. It just broke the previous level. So now the real worry is, does it get this bad or this bad? That's what it was like during this period of time. And during this period of time, it sold off just that much, like from above the river to the southern shore. And that's what it's done this time. So this is really a thick critical state, that if this gets much worse and it starts looking like these sell-offs, then this could easily bring it all the way back to 300 is the next leg down. That's another 10%. And that would only be a 20% sell-off. So this was a 20% sell-off here, and that was the second 20% sell-off. So this would get us to minus 20, and then that's minus 30, and that's minus 40 right there. So count your blessings and measure your risk, right? That's everything I want to cover for tonight. I hear I'm getting ready to cut the cake upstairs, so we'll get this published and posted, and we'll be ready for a violent day tomorrow, Friday, because nobody wants to hold that market over the weekend. Nobody. Take good care.